Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Oliver Crook. We're an hour away from the opening trade. Here's what you need to know. Nerves in tech as the Nasdaq dips ahead of Nvidia's earnings report, plus Apple making some new AI announcements, while CFO plans to step down by the end of the year. A lot going on. We're going to dive into the details. BHP expecting a turnaround in China's property sector in the year ahead, but plans to zero in on its copper portfolio as appetite for steel fades. And the political stalemate in France continues as President Emmanuel Macron rejects a government led by the leftist candidate. Talks continue today. Ollie.
Thanks, Kriti. We were looking at the Euro Stocks futures this morning, up by about 0.1% after closing down about 0.25% yesterday. FTSE futures, they missed a day of trading yesterday. They're back in action today, up by 0.33%. Brent crude, we're watching what's going on in Libya. Supply potentially being cut off there. They produce about 1.1 million barrels a day. And, of course, euro dollar every day this week. European CPI data and ECB speakers. All that to come. The countdown to the open starts right now.
Tuesday the 27th, welcome to the programme. We're around 36 hours away from the main volatility event of the week. That, of course, as Kriti says, is the Nvidia numbers. We're going to have a great interview when it comes to that set of numbers. Jensen Huang is going to be joining Bloomberg Television. Ed Ludlow, it's going to be great. But to be honest, that is really kind of where we are. We are waiting for that as an event. The market kind of gyrated a little bit yesterday around preparations for Nvidia. We did see big tech coming under a little bit of pressure. The Nasdaq was down. A little bit of a rotation towards some of the smaller caps, maybe. That's based on the Fed, maybe. But to be honest, we're kind of in wait-and-see mode. Kriti?
Well, it's a macro event at the end of the day, and this is coming, I think, 48 hours before the PCE data as well on Friday. So the back half is a lot is going on. The sell-off I thought was interesting because we keep talking so much about how much there's no downside protection on the Nvidia shares. Is this how that's manifesting? Are people kind of liquidating in some of the big tech space?
Do you think that's why they're selling?
That's my question.
They could be selling simply because they believe that the Fed trade is finally upon us, and you want to rotate towards smaller caps because that's the logical thing to do.
It could be. It could simply be a flip of the rates tech story as well. To me, I don't know. I thought the Apple story was more exciting anyway.
Yeah, I mean, Apple, usually was historically the apple of the eye of the market. I mean, we have a great chart today talking about the number of average volume of kind of how much the shares are traded. Apple was #1 for the longest time in 2016, overtaken by Amazon. 2020 comes in Tesla, $20 billion a day, and now year to date replaced by Tesla, Nvidia. So really the main event. Do we treat Nvidia earnings like a central bank decision?
Almost, yeah. It kind of feels like that. It kind of feels like it has that level of importance. I don't think the same is true of the Apple events. I am not, as an Android user,
I was going to ask. You strike me as an Android user.
I mean,
definitely.
We're still working on Guy Johnson as a separate project. But I think this is important, and I think this is perfectly handy that we see the chart on screen here, because Apple, yes, it is kind of the biggest stock that we watch as well, but they're known for timing the market. I think this is important in the context of Nvidia as well, because Nvidia is a macro event because of the financial conditions index and the way it kind of influences that via the stock market as well. Apple also announced that their CFO is taking a little bit.
You think this is a market timing signal, don't you?
I don't know. My conspiracy signals are going
because
off
he
right
times
now.
the bond market generally quite well.
He does, and I think this is the reason I think this is so significant is because people dive into tech bonds the way they dive into treasuries, and we don't really cover the credit angle of tech as much. But the fact that you can do that, it's because of this timing, and I don't know. To me, this was
the fact that basically they just believe that Apple is basically a sovereign credit, and as a result of which, when they sell, it tends to get a good price. It could be that.
It could just be that simple. I could totally be overdoing it. There is, for Android users like yourself, though, a September 9th event where they're going to showcase off their first AI iPhone.
Another iPhone. Wow, can't wait. It's going to be very exciting. Can't wait. Looking forward to that one. What I am looking forward to is an interview that Ed Ludlow has coming up. So Bloomberg Technology, it's got a half-hour special tomorrow. We've got an exclusive interview with the Nvidia CEO, Jensen Huang. Honestly, this is a big week for Ed Ludlow. He's got a rocket launch, which has been delayed from today into tomorrow, and he's got Nvidia. It's a huge week for Ed Ludlow. Tune in. It's going to be absolutely fantastic. Let's talk about kind of almost the other end of the spectrum, which is what is happening in the mining space. We go from high-tech to what is labelled in London as Jurassic Park, i.e. the big mining sector. BHP out with numbers overnight. To be honest, Mike Henry sounds pretty positive. What I find really amazing is that the big miners have managed to make money even as China has slowed down and reduced the amount of steel it is producing, and steel is really important to BHP. It's trying to big up the copper story going forward, but steel is still super important. And they continue to make money in that space as well, which I think is really interesting.
It's a very optimistic take. And even when the comments coming from Mike Henry that you're going to start to see some sort of turnaround in the China market in the year ahead. I don't know if the market's going to interpret it that way, because at the end of the day, their profit saw a squeeze. They cut their dividend. They're talking about and still investing. So there's a lot of CapEx spend that's coming about. I don't know if this is a positive for when it trades in the London session today.
Well, they seem to be saying that, the Chinese market is slowing down. I wonder when you plug that into the macro picture in terms of input costs for these sorts of materials going into it, is that a positive for the inflation story, though it is obviously a harbinger for slowing growth, potentially?
I think the copper story is a really interesting story. So I think that's where I actually spend most of my sort of focus when it comes to sort of listening to what BHP has to say. Copper is basically telling us about what is happening with the electrification story and what is happening with the Chinese story. Now, copper demand is going to be huge going forward, and it's interesting that BHP is basically seeing a short-term surplus but a long-term squeeze. And copper at the moment has come down really rapidly, and people are taking that as an economic signal, i.e. the global economy is slowing down. Is this just a short-term blip, I guess is the question. Yeah,
and we're getting some other economic signals from the German economy coming in right now. So we have consumer confidence coming in at -22, which is lower than had been anticipated. We also got the GDP revisions. All of those have been basically unchanged except for one, so it's still saying that there was a contraction by 10 basis points in the first quarter. Private consumption, again, estimated was supposed to come in at zero at -0.02%, worse than anticipated. Government spending a little higher than anticipated. But again, capital investment in the second quarter worse than anticipated. If you want any optimism, Guy, you didn't get it from IFO yesterday. Have a listen.
The German economy has been stuck in stagnation for some time, and this is getting worse. That's what the data is telling. What's been of particular concern is manufacturing, and in manufacturing we have a rather bad reading.
So that's sort of the economic picture in Germany, particularly leading into a weekend where we get those first of a series of state elections in two regions, where you're really seeing the political consequences of that German slowdown. And, of course, in a week where we're still seeing deadlock in French politics. Yeah,
it's a fascinating one, because we kind of knew that there would be deadlock. We talked about this yesterday, and now he officially comes out and says it.
Yes, there's deadlock, but I think there's progress. So if you think about this as a sort of
Guy Johnson being positive on France.
Well, no, let's not go too far here. But it's a process of elimination, right?
Yeah.
You've got to. We are not going to do this. So that means the chances of us doing this over here is greater. So it feels like we are, as we discussed yesterday, moving towards some sort of centre-left government. We're not going to see the Mélenchon-influenced government that Le Pen, etc., fear. So it looks like centre-left. And I'm hearing all kinds of names, like the CEO of Renault, and people, all kinds of names are being thrown into the pot right now.
Well, isn't it interesting that basically France voted more and more for bits of the extreme, and Macron is now coming out and saying, actually, what we need is a centrist government? Does that work?
Shocker. I would like a centrist government in the centre. But it feels like it's going to be centre-left.
Yeah.
So it's clearly not going to be centre-right. It's going to be centre-left. And can they manage to produce a government that will not fail at a vote of confidence? And I think that's the critical thing. We don't know. I think the fact that we're getting more and more names around that kind of space is really interesting. So Cazeneuve was the story over the weekend coming into Monday. Looks like other names are coming into the fray as well now. They're struggling to find somebody to centre that, to coalesce that government around. But it increasingly feels like it could be a technocrat. That is really interesting as well. Somebody that comes from industry, maybe somebody from outside of politics. I find that fascinating as well. We're going to discuss all of this. We've got some great guests coming up to discuss all of this. Of course, Pooja Kumra, TD Securities, is going to be joining us. We'll talk about the path ahead for rates, both for the ECB and also for the Fed. We've got the MEDEF vice president. We're going to be talking about this French story as well. Fabrice Sache is going to be joining us amid the organisation's summer conference. We are going to be speaking to the Artemis CIO, Paris Anand. Plus, we've got the former EU Trade Commissioner, Cecilia Malmström, joining us to talk EV tariffs, trade. Who should be the next trade commissioner? How should we respond to a Trump government? Lots going on.
There's definitely a lot going on, and that's just in terms of the narratives and the conversations we're watching. There's also plenty of data. Ollie was just talking about the German data that had broke at the top of the hour. We're also at 10:30 a.m. UK time going to get a auction coming out of the German economy, about $4 billion worth for the 5-year maturity. We also have a focus back on the States at about 3 p.m. UK time. That consumer confidence data is likely to move the markets, maybe not to the same extent as Nvidia or the PCE later this week, but it is something that is certainly tradable. We got a 2-year auction at the 69 for worth about $69 billion as well. Then some ECB speak, I was about to say Fed speak, from Knott and Nagel as well. We also have a speech from Keir Starmer coming out later today. I want to say it's about midday. And I believe Jake Sullivan is officially in China making his state visit.
So there's an unofficial meeting today. I think the official meetings are tomorrow.
He's in China.
He's in China. He's in China. There's a back channel. We've got a live shot, actually, which we should probably bring up. There you go.
Waiting for him to exit.
He is in China. He hasn't actually sort of formally hit the ground yet. We will bring you that moment. Oh, maybe he has formally hit the ground. That is, I mean,
he's hit the ground. He has not stepped off the plane.
Has he exited the plane? I'm getting confusing signals in my ear. I'm assuming that there is a shot of a plane door that he has not exited the plane. So he is officially still on the plane and not on the ground. Anyway.
But we think about all this stuff when we think about kind of the relationship between obviously the U.S. and China and everything that goes on there. I mean, are the back channels, how sort of robust are they? Are those conversations happening? And you think about the sort of orthodoxy that has guided foreign policy about peace through trade, that going into question, as you can see, he's walking out of the plane there now. Having that conversation with China seems critically important, even if you're not going to yield a specific outcome. Well,
I think one of the other pieces of this is we talk about this in the context of tariffs and trade, et cetera, but it looks like part of this visit is also talk about China's backing of Russia, and that's going to be a big piece of the conversation in terms of the trade relationship there and how much the U.S. can influence it.
It just feels like we're in a tit-for-tat kind of trade war at the moment. Where next? Where's it going to go next? The Chinese... It's really interesting to see how the economic data is going to influence their thinking in terms of how this is going to progress as well, and how maybe that is going to override some of the geopolitical stories that they want to focus on right now. And you could see it in the currency. You can see that they're holding the currency as is at the moment. There has been some depreciation. Would they let that go further? That would send a bad signal. There's all kinds of things happening here in that interplay between the economy and geopolitics. And it feels like the economy is kind of losing out at the moment relative to the geopolitics and how China wants to position itself long term.
Well, it's crucial here that Jake Sullivan, for our international audience, is the national security advisor at the end. So in addition to the laundry list of things you also added, I'll add one more, which is what's going on in the South China Sea, the relationship there with the Philippines and Taiwan as well. So the timing here is crucial.
Let's turn to another geopolitical event and get you updated on what you need to know this morning. The Ukrainian President Volodymyr Zelensky says the country's energy infrastructure has suffered significant damage. This is after Russia fired more than 100 missiles and nearly as many drones at power facilities across Ukraine yesterday. The latest attack comes as Kyiv continues its incursion into the Kursk region of Russia. The Telegram CEO Pavel Durov is being questioned in France over claims the messaging service failed to properly fight crime on the app. The magistrate must now decide by tomorrow night whether to press charges against Durov or name him as a witness in the investigation and let him go free. And Meta CEO Mark Zuckerberg says the White House, quote, pressured the social media giant to censor content related to COVID-19 during the global pandemic back in 2021. Zuckerberg adding that he regrets not being more outspoken about this. It comes amid, of course, growing global debate over how far social media companies should go in policing comments, images and other content posted by their users. Two kind of related stories there in some ways. The extremes, you could argue, maybe being talked about in the Telegram story, and how far that messaging app has gone in terms of managing content. You could argue that you've seen, obviously, governments pushing back quite strongly. The COVID pandemic story is kind of an example of that. Where's the balance, I think, is what we're trying to figure out here.
Well, the timing is everything here because, of course, we're counting down to the U.S. election as well in November.
Yep.
And the misinformation is such a big theme in that as well. But it also sets the precedent, I think, for social media companies over in the state, to your point, of how the EU handles Telegram and what kind of precedent it sets for, well, Meta, you mentioned, but also X. And of course, Elon Musk has been at odds with the EU for some time. So I almost feel like this is a little bit of a roadmap in what some of these other social media tycoons could face in this part of the world.
Entirely. And bring it into that sort of political discussion. It's not just about the election and misinformation there. This is a primary sort of discussion within the United States and Europe about sort of free speech and part of the sort of political debate that's going on within society, this sort of culture war. This is exactly kind of sitting at the center to. You have the conversation around Facebook, perhaps, you know, now saying that they're feeling a bit bad, that they sort of acquiesce to Biden's request. Telegram sort of absolutist about this. The other thing I find interesting is he's also a French citizen. And French citizens, France does not extradite its citizens to other countries, even upon request. So, I wonder if that's part of the conversation in terms of why the French decided to move.
And I believe the UAE trying to get access to that because he lives in Dubai at the moment. So the UAE pushing for access to the detainee. Of course, we're going to cover that and plenty more. Coming up on the program, we're going to see how BHP opens in London. We're about, I believe, 5 minutes and counting away from the close over in Sydney. This comes after the miners signaled a potential turnaround, plus Chinese EV makers seeking ways to get around European tariffs. We're going to hear about Xpeng's strategy next. Also next, the Fed's Mary Daly agrees with Jay Powell. The time has come for cuts. We're going to talk about whether or not what she said is all that different from the consensus over at the FOMC. If you have any questions of your own, please dive into the conversation. IB plus BBTV Go is the function on your terminal. Stick with us. This is Bloomberg.
Well, to my mind, we've been on this path of ready to adjust policy rates for several months. We just needed to get a little more confidence that inflation was truly on its path to 2%. And I wanted to see the labor market come into balance, but I think that's completely happened. And the risks to our goals are now balanced, and the time to adjust policy is upon us.
The labour market, the labour market, the labour market. How many times can Fed officials say the labour market? It seems many, because that seems to be the focus now. That Mary Daly, of course, of San Francisco. Let's carry on the conversation. Pooja Kumra joins us now, Senior European and UK rate strategist from TD Securities, joining us around the table. Nice to see you.
Hello.
Good morning.
Good morning.
So the labour market's quite important, apparently. They keep mentioning it a lot. I think Powell mentioned it 20 times in his speech.
Were you counting?
I didn't count. Somebody else counted. And that sets us up for September. September the 6th, the payroll number that is coming up. I read your notes this morning. You predict that there's going to be a bounce back there. I'm wondering how the bond market is going to react if we get a really strong labour market report now, despite the fact that clearly the Fed is concerned that the labour market is showing signs of slowing.
As we said, we have talked about labor market so much that the July number was definitely one-off. So we are looking for a bounce back. Now, if that bounce back is above 150, I do see that bond markets will actually be selling off, which makes sense.
Yeah.
But I just feel the kind of message we've got from Powell, they are here to ease.
Yeah.
And it's hard for markets not to remove the possibility of a 50 cut, possibly not in September, but could possibly come in December as well.
So you've got 75 penciled in for the rest of this year. The market's got 100. Do you think the risk is to the upside on that 75 rather than the downside to that 75?
Upside. I think this is a Fed that wants to actually front load then back load their policy measures. So I do feel that if there's any weakness that is available, they could possibly go for 50 in December. But base case for September is 25. I think if they go too big, markets will wonder what is breaking in the system, and nothing is breaking so far.
In terms of, we talk about the Fed and the ECB now. We got this, the ECB data out this week, the Eurozone inflation. What function, in your mind, does that data serve? Is it just to cement 25 basis point, or does it actually evolve the debate meaningfully over at the ECB in terms of maybe 50 or sort of in the rate path within Europe?
I think when it comes to ECB, they have just given us a straightforward path, and I think that's where there's generally no volatility in the euro market just because they pre-announced everything. So we are still looking for 25, just given the fact that growth is still holding up. I know we have weak performers like Germany and France, but your peripherals are still doing well. Mm-hmm. And inflation is on the right path. It's sticky, which is something that they don't want to ignore. So I think they will still stick to 25, and that's going to be the pace. Our key is that I think we and most consensus are basically looking for more quarterly cuts just because growth has been holding up well. If we do see any shocks in US, does that mean even ECB needs to increase their pace of cuts? Yeah,
but for example, we have the chart up right now that looks at kind of what is the expectation from January of the Fed versus the ECB, and the Fed is aggressively cutting, materially more than the ECB, 125 basis points. ECB is expecting about 85 basis points, when really there is perhaps a stronger thesis to do more easing in Europe than there is in the US. Do you think that that could change?
I think in Europe we are seeing growth evolving. And the thing is, you also need to know that we did not hike till 5.25%, right? We were at 4%. We still had easing going versus the balance sheet. So I do feel there's a lot of monetary easing as well when it comes to balance sheet. We are still doing PEP reinvestments. So, but as far as the growth situation is concerned, I don't think that ECB will be pushing it that forward unless we see a big downside. And we didn't even see that during the Ukraine crisis. It was that time also ECB went 50. So I don't see the case for them to go 50 per se.
It feels like when we talk about the Fed versus the ECB and even the Fed versus what happens in Washington or the ECB versus what happens in Brussels, there's a very definitive kind of separation between the monetary and the fiscal. And I'm curious how much the monetary now has to take into account the fiscal, given that so much of the outperformance in the States has been driven by government investment. It's a similar story where you're seeing the outperformance in Spain, Italy, Portugal, Greece, where so much of it has been driven, again, by fiscal spend. Is that worrying for the ECB and the Fed that some of that spend is running out?
I think for Fed, they know more fiscal is coming, irrespective of whether it's whoever wins, whether it's a Democratic or Republican. For ECB, definitely that is a concern. But I think given how your euro area functions, they all want everyone to reach the 3% target. And most of the countries are not hitting their target.
Yeah.
So I think when it comes to how they talk about fiscal, they are still talking about countries consolidating rather than government spending more.
Right.
So I think the way we work in the euro area when it comes to a conservative system, I think ECB still wants governments to pull back than actually increase spending. And I think that especially comes from Germany, that they are so particular about the deficits, given the fact that that's the weak country and that's driving the euro economy down then higher.
Oh, this is the perfect conversation for this table, because one of the questions and one of the debates that we've had is whether or not these budget negotiations, I think September, I want to say 10th or 20th is the date, I can't remember which, is when the EU kind of is pushing again on those budget talks coming out of France, Italy, Portugal, Spain, notably left out of that. And I'm curious whether that's something you trade upon, this idea that they are trying to be tougher on that.
So I think most of these countries have been in EDP procedures since 2011. So I think markets will ignore it. But I feel what would be key will definitely be France, just given the fact that it does not have government. It has all the rating agencies coming in Q4 for their updates. So I think that is something where markets will be actually looking at. And especially, after the September meeting, we won't have much news to work on. So it's going to be all about France and how they handle their deficits.
So, but does that create any difference in terms of the spread compressing when it comes to oat boon spread, especially when so many people around this table have come and said, again, peripheral credit looks better than the core right now?
Totally agree. I think right now markets have just forgotten about the France story just because it's so broken. They know nothing extreme will be implemented in terms of policy measures from left or right. But it also tells you that they're going to be in trouble with the European Commission when it comes to reaching their fiscal targets. So for me, holding OATs versus Bunds widener is going to be something that you will like to see play in September and October. And also, it's not a generally done trade, but actually holding UK versus France, it just makes sense, given the fact that you are seeing much more fiscal deviation in France.
France is trading 71 over Germany right now. What's that pricing in? Because that's higher than normal, quite significantly higher than normal. Is that pricing in an extreme event? Do you get a tightening over Germany if you get a centre-left, centre-right government? Let's say we get a centre-left government. Does that tighten up? But if it does tighten up, to where? Because you've still got this risk. How does this work?
I think right now we are going centrist, just given the fact that...
So the 71 is pricing in a centrist government.
I think right now we are just markets have woken up. This is the general seasonal we have seen that when you come into September, you have supply, you have markets actually coming back in action. I think 60-ish is something where we are going to remain, just given the fact that we do have a lot of fiscal events, as you mentioned, European Commission and rating agencies. So I think that spread will still remain till we have more convincing signs of having a government that can implement policies. Right now, we don't have those.
Pooja, always nice to see you. Thank you very much indeed for coming to see us around the table. It's a great pleasure. Pooja Kumra, Senior European and UK Rate Strategist, joining us from TD Securities. Coming up, we're going to get back to that French story. Who is going to be the next Prime Minister of France? Emmanuel Macron is trying to figure that one out. We'll try and figure it out too. That's next. This is Bloomberg.
30 minutes from the start of the opening trade, you are seeing futures indicate a higher, not by a massive margin, but just a barely green on the screen. We'll, of course, see what that actually looks like as we count down to those opening trades. In the meantime, a focus on what's going on in France. French President Emmanuel Macron is continuing talks on appointing a prime minister today. That's after ruling out a government led by leftist candidate Lucie Castet. Let's get more from Bloomberg's Caroline Conan joining us this morning out of Paris. Caroline, walk us through any insight on, one, who Macron is meeting today and what this timeline now looks like.
The question really is who is going to join this new cycle of discussions today. It's really hard to tell because according to this statement last night from the President Emmanuel Macron, he does not want to name a left-wing prime minister from the new Popular Front because he said that would create institutional instability and immediately lead to a vote of no confidence, backed, according to him, by at least 350 MPs and create, obviously, the government falling instantly. Of course, that statement led to immediate backlash among the left-wing. We heard from Lucie Castet, the chosen candidate of the new Popular Front, just now on France Inter Radio, saying it was a denial of democracy. The far left of Jean-Luc Mélenchon has a call for deposition of the president, even though that procedure has little chances of succeeding. And Macron did leave the door open to some of the more moderate left wings, such as the Greens and the Socialists, to potentially join a new cycle of discussions today. But we just heard again on France 2 television this morning, Olivier Faure, the head of the Socialist Party, saying he's not willing to join this parody of democracy. That's how he calls it. So it's really hard to tell at this point how Emmanuel Macron can actually end this political gridlock.
All right, Bloomberg's Caroline Conan, we thank you so much for walking us through kind of the nitty-gritty of what we're waiting to hear out of Macron and out of the government. We thank you so much. For more on that political situation in France, let's bring in someone who may just have a little bit more insight into the nitty-gritty as well. Fabrice Sache joins us this morning, Vice President of the French business lobby MEDEF. Fabrice, a pleasure to have you on the program. Thank you so much for joining us this morning. Let's build on what Caroline was just talking about here. And from your perspective, have you heard anything? I mean, a very simple question. What kind of progress are you hearing from your point of view?
Look, I think France is going through a political sequence that we usually don't know because our system provides clear majority. But in fact, we should be a bit calm because other countries in Europe are settling the same situation in a good way. Belgium has an experience, Italy, Netherlands. And in fact, France is learning how to do coalition. The most important is that the fundamentals, the economics fundamentals are good because we had been through 7 years of pro-business policy with corporate tax going down, with production tax going down, with massive cuts, with vocational training policies. We have lots of startups. So all this energy, all this economical boost, I think many people want to keep it in France. And we have lots of voices that are more rational about economic policy that are speaking now and say we need to keep that pro-business policy. And that's why also we are slashing down this extreme left, because what they are offering is just a nightmare for the markets, for the companies, for financing our investments. With the spread going up and the interest rate being still high. So we need really to continue the pro-business policy.
Well, that spread that you highlight there is something that really increased initially during the staff elections on the prospect of a more right-wing government to begin with. Fabrice, your colleague Patrick Martin had warned, to your point, that if the NFP kind of agenda was implemented, it would be unbearable for the country. Walk us through the specific measures, though, outside of the investment story that are affecting business right now.
They want first of all, this extreme left wants to increase massively the minimum wages in all sectors. It's unfeasible. You are not the same if your company is open to international competition or is in a closed market. So they don't take care. They have a vision that is very rigid. They want to increase the tax on gain of capital. You know that we have a flat tax in France, which helps us to attract many capitals. We still have difficulty to hire people, to find employees. We still have an unemployment rate that is still high, 7%, where other countries are at 4%. So we can do better and we can do more. But what we've seen, the best fiscal policy is a policy that decrease tax. When the corporate tax go down from 33% to 25%, the state got 60 billion euros per year of revenues instead of 30 billion because you stimulate the economy. For you, it's obvious, but we still need to explain that massively. And this is the job of business unions. And the MEDEF, the French business union, will not let this craziness happen, increasing from up to 130 billion tax, which is what the NFP proposed. It's a mess, and of course we will fight against this because it will be a break for the international competition for our corporations.
Fabrice, you talk about the fight. You say that MEDEF will not let it happen. Les Echos this morning talking about a militant MEDEF. What does a militant MEDEF do in order to make sure that what you are talking about does not come to pass?
That means we'll stop to shut up. We don't have to walk against the wall. We are proud of what we do. We created 2 million net jobs in the last 5 years. We create wealth. And we are not the one that will not speak and be shy. We need to explain the craziness of their measures, and we'll do it. I'm doing it now in Bloomberg. Of course, your audience knows all about this, but we do this also in all other media, general media in France. We'll do a Tour de France to explain this. We'll go in companies, we'll speak with members of parliament. We'll also push at the European levels because most of our economy is tied up with the regulation of EU. And we want to turn, competitiveness turn at the EU level. And this is what von der Leyen said. And she said like this because we fight for this also with all other business unions of Europe. So our actions have effects. Okay, so your actions have effects. You are going to fight. But I'm getting the sense that you believe that the 7 good years of Macronism, I guess you could call it that, you talked about this, they are over now. Is that fair to say? I would say that if we keep the same level of tax rates, we will be lucky. So I would say that we need to manage the downside. There will be no more upside. So our priority today is to keep the situation as it is. We see that in the UK or in the US, there are plans to increase tax, probably with some governments. In the UK, it's more precise. In the US, maybe. So for now, France, with the tax package we have for corporations, we need to keep it to be competitive. And France has made it in the last years with growth. We showed that in Europe, we can awake. We have some industry coming back. It's very hard for us because we lost a lot of industry. And when you lose your industry, it's hard to get back in the race. But we have an energy. We have lots of talents in France. We have a government that started a pro-business policy, and we will fight to keep it.
And Fabrice, you talk about the French competitiveness situation. You also mentioned von der Leyen and the EU competitiveness situation. What do you need at the EU level to happen in Europe? Because these sort of trade wars and competitiveness wars are not going to be won in Europe at the national level. They're going to be won at the sort of transnational level. What do you need from the EU?
Look, we are all in for the net zero and for the fight against climate change, but Europe is the only continent to really beat this race between 90 and 2010. We reduced minus 30% our greenhouse gas emissions, but we are the only region to do so. So we need to keep that ambition, but we need to add an industrial component, a competitiveness. Europe is losing ground against US, against China. We are very far away. Our GDP is half less than the US. 15 years ago, it was the same. Our productivity per hour is going down. The US is going up. US created lots of giants of digital. China is innovating, and China is becoming even a green superpower with solar panel, with electric EVs, electric vehicles. So Europe needs to shake, and we need less regulation, a little bit less regulation, smart regulation that helps to create this internal market, because this is the precious jewels of Europe. And that's why we think that Brexit, in our opinion, was a mistake. Because what is great about the European Union is the single market. So we need to increase this single market. to boost the trade between our countries, but we need less regulation and more realistic, pragmatic approach. Look, the regulation of Europe between 2017 and 2022 has increased 5,000 pages, 850 new obligations for corporations. If you speak about CSRD or CSD, due diligence, compliance, we are dying of compliance and due diligence. Very soon we cannot work with emerging economies. It's impossible. We make the business impossible. So more pragmatism we need.
Yeah, something echoed not only by you, but also the farmers we heard from quite a bit this year. You seem to have a clear idea of what the Mélenchon policies would be on France. Do you have as clear an idea of what Le Pen's policies would be on French business?
So Le Pen's main problem is on pension. You know, in France, like every, I would say, European country, we have this demographic shock, and we need to face the reality. So we need to have people working more long. So the government of Macron made a change for 64 years old to go in pension. And now we have Le Pen that wants to go to 60 years. But it's unbearable for our budget. It's, you know, the spending for pension is the first public spending in France, and I guess in many countries. And we don't have the pension fund. By the way, the president of MEDEF yesterday in his inaugural speech asked the government to move on with pension fund. Pension funds are good. It helps to finance our businesses. You know that every year, 300 billion of Europe are going to US of our European savings. Why? Because US is more dynamic, so people want to go in markets that are more dynamic, but also because the financial industry regulation in Europe is a mess. And also because we don't have this massive scale powerhouse from the pension fund. So we have solution. On Mélenchon, it's all craziness. So I don't know if I need to go into the details, but they want to increase the public spending in a country that is already a world record on public spending. They want to go more than 63 public spending percent on GDP.
On your view on that.
So understood, Fabrice. When it comes to the budget, I mean, fully understand both sides of the argument, but I really want to zero in on the bit that you were talking about when it comes to competitiveness with the United States, and a crucial point that you made, that so much of the savings, the money, is going to the States. And I'm curious what your take is on how France can combat that, given that there's a very real chance in the next 6 months you may have a Democratic president in office to succeed President Biden, who has already come under criticism from Emmanuel Macron in terms of the Inflation Reduction Act. But so much of that policy is based on government incentives and government subsidies. Is that something you think France can mirror, that France can copy in terms of incentivizing that kind of competition locally?
We cannot do the IRA in Europe, first because our budget are already completely down, and of course the US also is down and doing lots of deficit, but we are not the US, we are not a country, we are 27 countries. The EU has not the tax policy competence, so we cannot compare. It's at each country level. And you know, in the EU, if the French government wants to help its industries, it's public aid, and you have a control of the European Union. And of course, the small countries don't want that Germany, France, and Italy over-subsidy their industries. So we need to come up with a pragmatical approach, and we need also to build some directions that everybody agreed on. And for example, the capital market unions that we speak for 10 years or 15 years, now we need to make a content out of it, because this is the only way out for Europe. Otherwise, we are dead. You know, Europe has a hard time even to sign trade agreements. Look at UK. They go out with Global Britain. Do they sign a lot of trade agreements? No. So we need to come together to be powerful and to negotiate with India, with China, with US, because it's what is needed in our world.
Fabrice, if you're ever in London, come and see us. It would be great for you to join us around the table here in London at Bloomberg. Thank you very much indeed for your time this morning. Fabrice Le Sache, MEDEF Vice President. Interesting conversation. Lots to think about coming out of that. We'll carry on talking about what is happening in the world of business next. BHP full year profits edging higher, even as China's uneven recovery drags on demand for iron ore. We're going to look at how UK commodity stocks are going to be faring post these numbers. We'll talk about that next. This is Bloomberg. 11 minutes to the start of cash trading here in Europe, and it's going to be another exciting start to the day. As you can see, we do see the return of the FTSE, though, which is quite significant. So yesterday was a very light volume day. Remember, the London market was closed yesterday, Monday. The US market's closed next Monday. We're kind of in a little quiet period here right now. But we do have some volatility events that we need to factor into our thinking. Nvidia is definitely one of those. We're about 36 hours away from Nvidia. You've also got the inflation data out of the States coming up. That's going to be potentially another one as well. But Nvidia feels like the kind of the near-term risk. Joining us now, our Markets Live executive editor, Mark Cudmore. Are we just waiting for Nvidia, Mark?
Unfortunately, we are to some extent, and that's a weird thing to say for a macro guy like myself. Nvidia essentially is one of the biggest macro inputs in global markets now. And it's a hard one because when you come from my background, you're not used to the bottom-up analysis to study these earnings, and yet every single macro trader, whether they're a fixed income guy, an FX guy, a credit allocator, or just asset allocator around the world, needs to care about Nvidia. Even in commodities, they need to care. This is going to affect risk assets. It's going to move stock markets. It's going to say how the trend kind of sets for asset markets around the rest of the world over the next couple of weeks. So yes, we are waiting for it. Now, the backdrop going to Nvidia is very, very constructive. We've got central banks with dovish reaction functions. Growth is not brilliant, but it's okay. It is still doing okay around the world. And that environment of supportive central banks and still okay growth means that it's generally a positive macro environment going into those Nvidia earnings.
Which is great, except for if Nvidia misses pretty substantially. And I'm curious how that shows up or how that has a ripple effect, not just in the broader stock market, but in the broader kind of financial conditions, like how long that malaise could potentially last if we do see a miss, or if this is the time that winning streak snaps.
Yeah, we've been trying to work out kind of what the reaction function here is. I think it's important that Nvidia is so volatile in terms of its earnings and growth trajectory. It's been moving so fast, I don't mean just the stock price, that I think that if there's a miss that is not crazy, then it doesn't undermine the whole narrative because expectations have risen so high. So I think if we get a miss, we get short-term volatility, we get a bit of a disappointment. But given that we had the July clean-out of some of the kind of exuberance already, I don't think it's that bad, and we quickly get back into that bullish narrative. I think for us to suddenly kind of derail stock markets, it needs to be an absolutely humongous miss, a material miss that I just don't see any evidence from, and anybody involved in the tech sector tells me there's no chance of a miss in that scale. Yes, there's a chance of a miss just because our expectations got so elevated, not because the model is suddenly broken, not because the bubble is ready to pop from the bottom up yet.
And Mark, you're flagging concerns about too much expectation going into Nvidia. Is there too much expectation going into the Fed, into the ECB? Where is the market pricing on those rate cuts most out of whack?
Yeah, I think there definitely is too much priced in for rate cuts around the world for the next kind of 6 months or so. The hard bit, though, I mean, I think ultimately we'll see yields trade higher again, but it's a very, very hard trade to have because we know that central banks have a very dovish reaction function, most importantly the Fed. We know the Fed would cut 50 basis points if they're given an excuse. I just don't think they'll get the excuse to. But that means that every time we get some bad data, we're going to overreact, and we've seen that over the last couple of months. So it'll be a natural trend of front-end yields trying to rise higher over the 6 months, but every time there's a negative shock in the data, they dip really, really aggressively, and that makes it extremely hard to trade.
Well, Bloomberg Markets Live executive editor Mark Cudmore, thank you so much. And remember, you can get up-to-date analysis, insight from Mark and the rest of the team. Just go to MLIV Go on your terminal. Now, let's get your stocks to watch with Joe Easton from our equities team. Joe.
Morning, Ollie. So we're going to be keeping an eye on the UK commodity stocks today as the London market reopens following the long weekend. Now, the main thing to note is that 3% jump that we saw in the price of Brent crude yesterday. This, of course, coming from these supply issues over in Libya and the force majeure there amid the political struggle. So that would be potentially boosting some of the UK stocks. Also, note that iron ore is up around 3% as well this morning. So a double boost in terms of those commodity shares. There's the two-day gain on that, almost 5% for iron ore, coming from the reduced stockpiles over in China. So the stocks to watch are going to be the likes of Shell, also BP, potentially Anglo-American and BHP, of course, which you know has had earnings out from Australia as well. And looking actually a bit better than expected. We saw the Australian stock gaining around 2%. Most of the volume is in Sydney, but it does still trade in London, so potentially one to watch today. BP, a notable underperformer given concerns around their capital returns at the moment. So potentially a bit of a boost all round. Then I've also got my eye on Burberry. Now later today we'll get indicative results of the latest FTSE rebalancing, and Burberry set to drop out after 15 years in the index. Now Burberry has suffered from the industry-wide decline in sales in luxury goods. A lot of that, again, a China story coming from the slowdown there, but also its own brand revamp hasn't really panned out yet as they would have hoped. Year to date, down around 50% for that stock. And if we go back a couple of years, we see it down even further. A big slump for that one. Keep an eye on those results later. They'll be confirmed finally next week as well. Finally, one downgrade to bring you. One of Europe's largest industrial stocks, Schindler, is a sell at Goldman Sachs. They say that the outlook is dimming in terms of the lift and escalator business. We can see that stock's actually had a decent run, and Goldman was actually previously a buyer. They're actually deciding now's the time to cut profits on that one, take some profits, sell Schindler stock. Keep an eye on that one over in Zurich today.
All right, Joe Easton there with our stocks to watch. Got a couple other ones as well, some buybacks taking place. Santander is the one that catches my eye as well in terms of some of the moves. But, Joe, we will, of course, keep you apprised. Right now, futures looking barely in the green. From an index level, it's not that exciting. But, of course, there are a couple of moves that we're going to keep our eye on. Joe was just talking about BHP as well. We've also got our eye on this currency market because we are looking at 111.67 on euro dollar, right on the cusp of 112. We'll keep you apprised. The opening trade across Europe is next. This is Bloomberg.
Tuesday the 27th, a couple of minutes to go until the start of trading here in Europe. London is back, which is important because we're going to see some volume returning to the market. Yesterday was super quiet. Even over in the States, it was super quiet as well. We were down by, I think, circa 10% in terms of the volume. In terms of the steer we're getting out of the United States yesterday, Europe closed here, the US closed there. There's not really much in it in terms of the steer, therefore we're getting from the outperformance or lack of it that we saw in the States yesterday. So I'm not sure there's a great story that's going to translate into what we're going to see here in European futures, which I think will reflect the start of London trading, but Crook, I don't think much else. What do you got, Ollie?
Well, listen, Guy, I'm trying here for you. STOXX 50 futures down by about 1/8 of one, or up, I should say, about 1/8 of 1 percentage point. So really nothing, spectacular going on here. FTSE, as you mentioned, did miss a full day of trading yesterday, doing a little bit of catching up there, up by about 1/3 of 1%. And then S&P futures basically dead flat, up, 2 basis points. So maybe not exciting that much, Kriti.
You're really building up the excitement, and I love it. But there are a couple of stocks to watch. At least I think. Of course, we're keeping an eye on BHP. It is opening, or it was green on the screen in Sydney. We'll see if it continues that winning streak going into the open as well. Santander kicking off some of their buybacks that were well telegraphed, but it might be a little bit of a boost in terms of a fund flow perspective. By 1.5 billion euros expect to hit the market. They are indicated higher, but we will see what that actually shakes out like. And then Vivendi is the other one that's catching my eye this morning, is potentially selling its 24%, about 24% stake in Telecom Italia for the very first number that we're getting, which is about 2 billion euros. So, Guy, we are getting numbers around Vivendi. We got some early signs yesterday. We'll see how that shakes out in just a few minutes.
OK, we certainly will. It is time for the opening trade. Let's see what we get. London is going to be back. You've got oil stocks in focus. You've got the mining stocks in focus. They're going to be two areas that we're going to be watching out for carefully this morning. So commodities, an area of the market that we're going to watch out for. London is out of the gate Tuesday. Feels like a Monday, but we've got some volume coming back into the market, which is going to be significant, despite the fact this is the kind of the Christmas week for the summer. That's kind of what it feels like in some ways in terms of how we should think about what we are seeing here. But London is up by 0.4% as anticipated. Elsewhere, the STOXX 600 is super quiet, barely budging at the moment. We're up by less than 0.1%. The CAC 40 is up by 0.1%. The IBEX is up by less than 0.1%. Christmas in summer, Ollie, that's maybe how we're thinking about it. But beneath the surface, I'm sure things are going on.
Yeah, Guy, I've never really heard that before. Christmas of summer is an interesting sort of formulation for the markets this morning. And if Christmas came early, then it was for basic resources, which is up about 0.6% this morning. This is the best performer in Europe at the moment. Travel and leisure down by about 0.5%. That is the sort of big loser there. Technology selling off again about a quarter, about 1%. We saw it fall about 1% yesterday. And remember, yesterday in the session, we did see real estate outperform. We're not seeing that again this morning, which is basically dead flat. So the winners this morning, basic resources, losers, technology and travel and leisure.
You got a little bit of oil love in there as well when you look at the FTSE 100. And some of this is going to be just a magnifying the move that we're seeing in the macro as well. An 81 handle on Brent crude. And remember, this is coming off of, I believe, a 3% rally in yesterday's session off oil as well. We haven't really talked about this. This has been like a Libya output story where you are seeing the eastern Libya government shut down some of their oil pipeline flow. There has been mixed reviews about whether or not this is something that sustains. But the way it's showing up in the FTSE 100, which, by the way, was closed yesterday, higher by about 1.4%. The likes of Shell, BP is your outperformer. But then you've got a little bit of your other commodities as well, to your basic resource point. Anglo-American is one of them. It looks like we're still getting, I'm trying to find BHP here, but it hasn't shown up yet. But it looks like commodities very much in focus, Guy, this morning.
Unsurprisingly, decent numbers coming out of that company. It paints a positive picture. I think these companies are making money even if China has slowed down, which I think is really significant and quite important for this cycle. Yeah. Though it's interesting, Mike Henry's talking a lot about copper. He sees that as the future. Remember, we had the failed takeover. He still sees that copper story as being super important for him. So despite the fact that others are sounding cautious when it comes to consolidation, Rio Tinto, we do still see some companies within this space talking potentially about some big deals, still being needed and relevant. Yeah, with a real drag in the manufacturing sector, which we've seen, across Europe. Obviously, we've seen it in Germany, but even the manufacturing PMI over in the United States. So maybe some of those that demand just is not there at the time for the time being. And I should mention that BHP is trading higher by about 1.5%. On your screen right now, you're seeing Rio Tinto higher by 1.4%. I think we're still waiting for the BHP numbers to shake out. I'm not seeing a ton of volume show up. But when we get that live pricing, we will bring it to you. We talked a lot about the upside. Let's talk about the downside as well, because, of course, Nvidia seems to be the big macro event that we are seeing on Wednesday. In the lead up to that, Guy, we're seeing a continuation of that pain in the tech trade. ASML, SAP, some of your biggest weights and some of your underperformers on an individual basis this morning. Well, yesterday we saw a sell-off in the Nasdaq. Yeah, so it's just a catch-up. It's just, there's a kind of... Get excited, Guy. The sell-off in the Nasdaq, I think, was significant. There is a rotation. Clearly, the market is reacting. I think probably less to the build-up to Nvidia and more to the build-up to the Fed cuts. So you're sort of seeing that turn start. Is it a step too far, though, to believe that you want to be buying small-cap, mid-cap stocks in an economy that theoretically, according to the Fed, is slowing? Even if you get a soft landing, is that the space you want to be in? I think is a key question. And I think you are seeing a kind of knee-jerk reaction maybe to Jackson Hole. Yeah. Whether that has got legs. We've already seen one head fake already into that move. Yeah. Is this another one? So still very much macro driving the story. We actually asked Pooja Kumra over at TD Securities that very question on what her outlook looks like. Take a listen to what she had to say. Holding OETs versus Bundsweiner is going to be something that you will like to see play in September and October. And also, it's not a generally done trade, but actually holding UK versus France, it just makes sense, given the fact that you are seeing much more fiscal deviation in France. Pooja Kumra there from TD Securities, speaking earlier on the program about the need to keep an eye on, well, really all the markets. It looks like the Fed seems to be in control right now when it keeps in terms of driving the macro trade and whether or not those rate cuts actually spur some investment in American assets, pull some out of Europe. Let's see how that all shakes out. Paris Anand, CIO over at Artemis, joins us around the table this morning. Good morning. Good morning. Welcome to the set. Thank you so much for joining us. Give us your take here. Is it really all about the Fed? Is that the only driver here, that a 25 basis point rate cut in September or a continuous easing cycle that we see into the back half of the year? Is that the tailwind for stocks right now?
Well, it's a great question. I think that actually my assertion would be that the market is overly focused on the sort of direction of central bank policy. And I would say that that's been an obsession with the market over recent years. And actually, when I think about what is going to shape the real economy, what's going to shape markets overall, actually whether the Fed chooses to cut by 25 basis points or 50 basis points, or the direction of cuts, is going to have much less impact on the broad outlook for corporate earnings and the broad outlook for markets in general. I think it will have these short-term knee-jerk reactions just because of the sort of reaction function in markets. But I would say one of the most significant themes for the coming year is that actually people should be focusing less the actions of central banks.
So in terms then of kind of the pain that we've seen arguably in the States and kind of this rebound that we're seeing, I'm curious how that translates over to the European story. We were reading some of your notes earlier. You've got your own little acronym. We like to talk about granolas over at Goldman.
It's a breakfast show. We should talk about
You've got your sensational six.
Yeah.
I believe you're calling them Cheerios.
Yeah, absolutely. So what we were doing in terms of the granolas versus Cheerios was really trying to sort of put into the foreground the idea of the extent to which that kind of market concentration that we've seen in lots of the equity markets globally has also been sort of mirrored in Europe. There are certain companies that seem to sort of meet certain standards in terms of their, people's perception of the quality of the companies, and hence that willingness or that belief that they will grow and they will offer good returns for shareholders, whatever the kind of the macro environment. Our sort of assertion is actually when you look deeper within the market, you can see such great value on offer. And one of our core beliefs over the coming years is that valuation, the starting price you pay for a security, will have much bigger explanatory power in terms of the future returns in the cycle to come versus what we've seen over basically the last decade.
Why is that? What is the underlying change, the underlying assumption that is going to shift to make that happen? Because cheap money has made exactly the opposite happen. Are you suggesting that era is now over?
That's exactly right. And I would say that one way to almost look at it is that when you're in that zero interest rate policy world, the natural gravitational pull for multiples is up.
Yep.
And the propensity of investors and the way the value accrues is all in those kind of much longer duration assets, whether we look at fixed income or equities. But, we are now in a fundamentally different environment. We're going to have higher interest rates across most markets, especially in the West, for an extended period of time. And what that means then is that gravitational pull of multiples is actually down, not up. And therefore, actually thinking about what your starting price, what your starting valuation is, becomes much more important to the shape of future returns.
But valuations are elevated now because of that cheap money. Do we need to see a reset of those valuations in order to make what you are talking about come to pass?
Well, I guess this comes back to the granolas versus sort of Cheerios point.
So the reset's already happened, or it hasn't happened in those stocks. So they're already cheap, is what you're suggesting.
No, what I'm saying is that because of the extent to which, you talk about valuations being expensive.
Yeah.
Now, the value in public markets, those more lofty valuations were accorded to actually a relatively small percentage of the overall market. I'm much more concerned actually about the valuation of those kind of that bubble, if you like, is much more in private markets than in public markets. Most public market investors didn't really get the chance to participate as strongly. So therefore, when you look more deeply within the market, there's actually a lot of value on offer, and there has been for a number of years.
Does the index, but thinking about it from an index point of view, does the index need to reset for that to happen? I.e., if we see a shift away from the high-value tech names, the Magnificent Seven, the granolas maybe, does the index fall in that kind of environment? In part, it does. Right. In part, but also but the most important thing is the internal rotation within the market, and therefore I think what you're more likely to get is almost kind of directionless or kind of sideways tracking markets within which there'll be a much more profound rotation.
But somewhere where we will continue to pay attention to the central banks is potentially in the FX market. And I'm looking at cable right now up at 132, which kind of snuck up on me. That's really moved precipitously in the month of August. How far can you see that actually going? How strong can cable get when you see the sort of differences that we're seeing between the Fed and the BOE?
Yeah, so look, if you think about the sort of the devaluation of sterling relative to the dollar, that's a story that's going back almost sort of 10 years now.
It's very personal to me because I moved to London in 2014 and at 166 and out at about 115. So yes.
Yeah, and when I used to live
I want to see where we can get back to.
Yeah, when I used to live in the US, the dollar was sort of $2 to the pound, right? So it's kind of it shows you how profoundly these kind of swings in currency valuation can occur. No, I think our medium-term view is that actually there will be kind of ongoing downward pressure in the dollar. When you look at the sort of long-term fair value metrics, you look at purchasing power parity, you look at all of those sort of factors, and what I anticipate happening in terms of the need for the US government to continue to issue bonds in order to kind of service its sort of fiscal needs. I do think that's going to put downward pressure on the US dollar against against sterling, but also against other currencies as well globally.
Yeah, and it's sort of music to my ears to hear you say we need to stop paying attention to central banks quite so much, because it seems to be the only thing that is really driving things within the sort of the equity markets. My question to you is, how much do you think about geopolitics, particularly the question of trade, is going to be a protagonist in the question of markets?
So I think elevated geopolitical sort of tensions are something that actually, again, we've lived with for quite a period of time. And I think it plays its own role in why I think what we're going to be living with for the foreseeable future is just more kind of elevated inflation, especially in Western economies, because, it is a source of, it can be a source of supply chain disruption. It can pull forward certain types of spend, which are not spend of discretion, they're spend of, compulsion. All of those things end up putting pressure on, prices in the medium term. So, one of the key things that we talk about is this idea that, inflation isn't a single phenomenon that comes in a kind of, a wave and then it sort of disappears, which is where really the focus of the market has been. What is going to happen to this particular individual cycle of inflation? Actually, when you look back over history, inflation is more persistent and it occurs in waves. So one of the things that I think market participants shouldn't get too comfortable with is the idea that there's this one period of inflation spike, it'll spike and then disappear. I don't think that will be the case.
Well, one of the arguments for that resurgence of inflation, or even persistent inflation, as you put it, has been the fiscal spend that we're talking about. There's also an argument over in the States, and I'm going to throw Europe in here as well, that you just follow where the government is willing to spend the most. So in Europe, it might be the defense sector, and you've seen that sector outperform. In the States, it might be the chip sector, simply as a function of the CHIPS Act. What does that trade look like in the next 6 months, and arguably the next 12 months, as we get a new administration?
So I think that, again, when you think about, the direction of travel for most of these Western economies, and you think about the direction of travel of government economic strategy, and I think this is going to be the same whatever the outcome of the election in November, I think there will continue to be that elevated level of government spending on fixed asset infrastructure, also mirrored by, I think, the corporate sector is going to be spending more on fixed assets.
Sure.
And I don't really think that that's a decision of, election or it's something that they're doing voluntarily. I think it's something that they have to do.
Yeah.
I mean, I've just spent the summer traveling in the US and Canada. And having recently sort of lived in Singapore and travelled around, Asia as a region, you sort of compare the infrastructure between the economies that we describe as sort of developing economies and, the mature economies in the West, and the infrastructure is creaking.
But 4 years ago, and I fully hear your infrastructure point, your government point in that, but 4 years ago when we went through this election cycle in the States, there was a very clear trade, a Trump trade, a Biden trade, and you could see the markets trading tech on it, trading bonds on it, et cetera. That trade doesn't seem to emerge yet. And we are two couple months counting going into the election. Why is that? Why is there that absence? Is that a dislocation in the market setting us up for some sort of surprise come November 5th?
No, I mean, again, I think that when you look at sort of some of the policies that have been put in place over recent years, one of the things to remember is that when you talk about sort of big infrastructure bills and things like that, they take several years to play out, right? These are not things that sort of they might have an immediate sort of reflection in the market in the very short term, but when you actually look at their impact on the real economy, you're talking about something that is going to shape the real economy for many years in the future. So my argument would be that, don't look for that single trade. Just think about what are going to be the fundamental drivers of the real economy in the US, in Europe, and elsewhere in the world over the medium term.
Paris, great to see you. Thanks for stopping by to see us. We greatly appreciate it. Thank you very much indeed. Paris Anand, CIO at Artemis, joining us around the table. You can pick your granolas. That sounds like a tasty breakfast cereal. Cheerios, I'm sure, are absolutely delicious as well. But
I'm so hungry now.
I like to focus on the core six. Like, it doesn't sound that tasty, but believe you me, it is. Here you go. Novo Nordisk, LVMH, Ferrari, ASML, Schneider, Nestle. Only one of those is down today. Reacting to the tech story yesterday, the Nasdaq selling off, but you can see it's not that big and greater reaction. Luxury looks like it's bouncing back a little bit today. You're certainly seeing that, and some of the healthcare stocks bouncing back as well. But it's Nestle that leads the charge, up by 0.8%. So that's your core breakfast. That's the core of your kind of breakfast offering, our breakfast offering, first thing this morning. But let's add to it. Let's add a few bells and whistles. Joe Easton's here with the other stocks we need to be watching.
So as expected, Guy, a lot of the action today is in the UK commodities. Stocks we're seeing the likes of BP, Shell, Anglo and BHP gaining both a gain in the price of crude oil yesterday, and the iron ore price moving up today on potential rebounds in Chinese demand, boosting these stocks this morning. As we mentioned earlier, BP has been a bit of an underperformer of late, so that is getting a gain. And BHP, of course, reporting earnings today, potentially better than expected on their copper outlook for that company. Then we'll also take a look at Vivendi and Telecom Italia. This one breaking in the Italian press earlier today. Vivendi potentially going to sell down their stake in Telecom Italia. Potentially some big news out of that market. So we are seeing a gain of around 1% in Telecom Italia today. Another one moving in the UK, though. This one caught my eye. Ocado getting a deal in Australia with Coles, the retailer, for a new automated warehouse, something Ocado really needs. They've been suffering on a decline in some of those orders for those warehouses. That stock getting a boost. Actually one of the better performing UK stocks today. But the best performing UK stock is Bunzl. Now this one jumping, it's airport catering and also outsourcing general catering as well. Really strong sales out of this company this morning. We're seeing a 12% move higher in that stock, the best performer on the STOXX 600 and also in the UK as well. Santander, meanwhile, Kriti mentioned this one earlier, potentially another 1.5 billion buyback coming from the bank over in northern Spain. 1.3% gain for that stock. Pretty decent given the relatively calm markets today. Then we got Zurich Airport in the earnings space. This one actually dropping, seeing some weakness in some of their passenger numbers, according to the company. A 5% decline in that one. Pretty disappointing out of them this morning. But actually, the best performer and the worst performer on the STOXX 600 today actually come in the rating space. We've got Continental raised to buy over at UBS. UBS reckons the spin-off of the company's auto parts business, making them focus instead on tyres, could see them return 6 billion in share buybacks over the next couple of years. And finally, AB Foods goes down to sell this one at Deutsche Bank. They think the margin recovery of Primark is coming to an end. They recommend getting out of that one, and we're down 2.7% in London today.
All right, Joe Easton from our equities team walking us through, some of our stocks that we're keeping an eye on. Coming up, we continue that conversation with BHP, up higher as the world's biggest miner's full-year profit edges higher. Basically, they talked about profit, they cut their dividend, they're talking about growth. There's a lot going on, especially when it comes to China's uneven recovery. We're going to dive into the details after the break. But as we head there, take a listen to what Marcus Garvey, the head of commodity strategy over at Macquarie, had to say about metals demand in China.
The weakness in the Chinese property market is very clear when we look at the ferrous complex, because if you look at long steel production, which is the form of steel that goes into construction activity, it's very soft. It has been for the past 2 years. We've not seen any improvement this year. If anything, we've seen a modest further deterioration.
Property sector itself, which makes up about 20% of steel demand, that is weak. It's been weak for some time. We've seen lower or fairly low levels of both sales and new starts. But the Chinese government is enacting policies that are intended to address that, and that includes relaxing some of the constraints on property purchases. There's a government program underway to mop up some of the excess inventory, and we expect those to start to have effect through 2025.
CEO of BHP, the world's biggest miner, Mike Henry there, speaking about what he sees in the Chinese market, talking about maybe steel demand plateauing at this point, though others firmly believe that there's still further weakness still to come out of that space. But as iron ore is weakening up, he really likes copper, and that seems to be the narrative that he's pushing right now. What does that do in terms of his M&A strategy going forward? In terms of the share price reaction, we need to discuss that as well. We are seeing the mining sector outperforming this morning. It's a big outperformance. Ollie Crook was just joking in the break that this is a sector that is up by 1.4% this morning. That feels in August markets like quite a decent-sized move. I am genuinely getting excited about this. So let's talk about what is happening here. I jest. Of course, I'm not getting excited about this. Martin Ritchie joins us now to discuss this, Bloomberg commodities reporter. Let's start off and talk a little bit about China, first of all, Martin. What is this company is still profitable, which I think is really interesting given the weakness we are seeing in China. But what is he telling us about what he sees happening in the Chinese economy and the demand we are seeing for steel products? Because it's not just the housing market that consumes steel in China.
Yeah, that's right. I think there was an interesting contrast, really, between all this sort of very negative headlines, gloomy stuff we've heard about commodities markets in the past few months, versus these results, which are in line with expectations, profits still rising. I mean, that speaks to sort of BHP's cost advantages, but it also speaks to perhaps that some of these commodities are still performing okay despite all the noise. So there was a fairly mixed picture from BHP about the outlook in China. As you said, they did highlight the ongoing contraction in the property sector. Mike Henry, the CEO, mentioned that 20% of steel now goes to construction. That's way down from like 35-40% in previous years. But at the same time, there's other segments, just to go back to your question, there's other segments which are taking up some of the slack. Machinery, equipment, some infrastructure spending, transport and cars is obviously a major part of steel demand. And those are helping, I suppose, to blunt some of the worst impact.
And just how bad is the crisis in Chinese steel, particularly when we're seeing headlines like we had from yesterday in Canada, where you're seeing trade barriers being erected? How challenging is this going to be for China?
Well, there have been trade barriers being erected against steel in waves going back 2 decades. This is just the latest. There has been a surge of Chinese exports this year. Perhaps not on the scale we've seen in previous times. We talk about steel crisis. Certainly, there's a big contraction in demand from construction, and the unusual thing about this particular slump is that doesn't seem to be much immediate relief from it. Again, BHP talks about the market perhaps bottoming out, but not until next year. And there's no kind of major stimulus. There's no prospect of another big construction boom as we've seen in the past. So this is why you've heard the CEO bigging up copper. All the big miners like to talk more about how much copper exposure they will have. And again, he was a little bit sanguine on short-term prospects for copper, alluding to a slowdown of perhaps down to 1% to 2% growth in China from 6% last year. But again, like everyone else, talking up the kind of long-term boom from renewables, etc.
All right, Bloomberg commodities reporter Martin Ritchie walking us through the BHP story here, seeing it higher in today's trade as well. So we're going to keep an eye on that, despite the fact that they did actually cut their dividend for the reasons that Martin kind of outlined there. There's another story that we're watching, of course, which is what's going on in the oil space. You are seeing some marginal gains there when it comes to Brent crude, although now pared back. An 81 handle is what we've got an eye on. This is related to the Libya story. The Eastern Libyan government is talking about shutting down some of the oil production, the oil exports. But just to put this into context, Libya only makes about 4% of OPEC's oil production broadly. So there is a thought that even though it did actually gain in yesterday's session to the tune of about 3 to 4%, pared back the move because it doesn't actually have that much of an implication to broader markets. That's really just a function of this Eastern Libyan government using this as a mechanism to threaten what the rest of the country is doing as well. We're going to dive into the EV story next. Stick with us. This is Bloomberg.
Volkswagen has more strength on globalization, quality, manufacturing, and supply chains. We have more advantage on artificial intelligence, software, and electrical and electronic structure. So I hope we learn from Volkswagen's strength to make up our shortcomings.
They're the chief executive of Xiaopeng, the Chinese EV maker, talking about the partnership with Volkswagen, where, of course, Volkswagen has the know-how of building large volumes of cars through many, many decades, and they have the know-how in terms of AI and digitalization and the inside of the EV and the car. Hence that partnership. Xiaopeng is also a company that is facing now 21% tariffs to sell their cars into the EU, which is supposed to be a key market for them. So we wanted to check in on how sort of Chinese EV deliveries have been going so far year to date. When you look at the different regions, you see a very very clear story here. When you look at what's happened year-to-date change in Asia, EV sales from China are up 36%. You look at Latin America, we're close to 500% change year-on-year, year-to-date, in terms of the number of EVs that are being delivered. When you look at North America, where we know the Biden administration has thrown up trade barriers of 100, 125%, that is not happening there, down by a quarter. And Europe, similarly. But when you look overall, despite all the things you're seeing and the difficulty China's having in the U.S. and in Europe, up 17% year-to-date, and just in the month of July, up 14%. So really, this is sort of a key conversation going forward here, and I think also in the inflation story, Kriti.
It's a fascinating one. And of course, this also comes off. You mentioned some of the other regions. Canada, I think, is in the news most recently, Guy, in terms of hitting China with those tariffs. I'm looking at these numbers, though. 100% levy on electric cars, 25% on steel. Now, Bloomberg had reported this previously, but this is now officially confirmed. I think we're getting the Chinese response this morning.
We are. Understandably, they're upset about this.
Yeah.
Is it too late to avoid a global trade war? Are we already in a global trade war? If we're not in a trade war, are we in a subsidy war? The IRA obviously is needing to be folded into all of this. If we get Trump, do we get a trade war? If we get Harris, do we get a subsidy war? It does feel as if we are shifting into a much more aggressive phase of this process, and there's quite big tectonic moves that are taking place here. The Chinese clearly are pushing the EV story. Are the Europeans trying to encourage domestic production, or are they simply trying to encourage the Chinese to build their production in Europe? I think there's some really difficult questions that need to be answered.
One that, and you'll know about this quite well, one that it doesn't feel like the market is necessarily taking into full account. And you saw then pieces of it. I think you've done the reporting on things like pork and dairy, et cetera. You're seeing that show up in Europe. But this is not a 2020 redo in terms of pricing in that kind of trade war or that subsidy war, as Guy puts it. There's still kind of a wait-and-see approach to this.
Absolutely. And again, we still wait to see how China is going to respond. Of course, the trade balance is steeply tilted in their favor. So there's a limited capacity of what they can do in terms of the European, but they can still make it hurt. And the question is going to be, and as we alluded to a little bit earlier, to what degree will the economics trump the politics of this? And I think what we've learned over the last few years is that actually politics are a lot more important than economics than we had assumed in sort of pricing in the sort of idea of peace through trade.
Let's take it through the German lens. Yeah. The German economy is really struggling right now. We saw that. We spoke to IFO yesterday. Really difficult situation, evolving and continuing to worsen, according to IFO. China is a key part of that. Is Europe willing to sacrifice the German auto industry at the kind of within this trade war? What is Europe willing to do? What is it willing to protect? What is it willing not to protect? In order to go forward from here, is it trying to protect the auto industry? Is it trying to encourage the Chinese to come in and just build here?
I think it's both, right? Yeah. But I think that when you speak to the executives within the German auto industry, the way that they see this is they have basically 2 to 3 years to really get their competitiveness within Europe under control before the Chinese have their own production facilities within the European trade barrier and in Hungary.
But then you've got to think about the German manufacturers as well, having a huge footprint in China, which is at risk as well.
Yeah. Well, who better to speak to about this than the former EU Trade Commissioner, Cecilia Malmström, who's also a non-resident senior fellow at the Peterson Institute for International Economics. Thank you so much for joining us today. I mean, I guess the question is, after we've seen what we saw from Canada yesterday, are we already basically in the foothills of a trade war? Where do you see this ending?
Well, I hope we're not in a trade war, because that would be bad for the global economy. But of course, we have a problem with the Chinese subsidies in EVs and other items. The EU has imposed preliminary tariffs on EVs between 9% and 36%. They will then be formally adopted by November. And the Chinese have other anti-subsidy investigations as well in the dairy industry, in pork and cognac, I think. So they will retaliate. But I hope it stays there so it doesn't escalate further, because we don't need trade wars in the world right now.
And of course, the Chinese, what they will say, and what they have said to a number of these, is that actually they are legitimately outcompeting the Europeans in terms of the products. And I think that there is, obviously the Europeans are very quick to say, no, it's actually all to do with subsidies. There's got to be some truth somewhere in the middle. How does Europe become more competitive in dealing with some of these issues? Because that is something that they also inevitably need to deal with.
Absolutely. And the dilemma here is that we need those Chinese cars. We don't have enough EVs at affordable prices, high quality in Europe. So that is why we have not imposed 100%, because we don't want to stop the imports. We don't just want to slow down so that Europe can catch up. And that is ongoing discussion right now. How can we support European car industry and make them catch up with the Chinese. And right now, there is a little bit of a vacuum in the European Union. We are waiting for the new commission to be installed. There is no government in Paris. We have discussions in Germany. So it's hard to make decisions about this. But they still definitely dominate the whole autumn discussion in the European Union.
Valdis Dombrovskis does not want to be the trade commissioner anymore. He picked up that from Phil Hogan when he stepped aside. Who do you think? Have you got any names? What are you hearing? Who should be the next commissioner?
I don't know. I hope that it is someone who can see the value of open markets, of free and fair trade, but still be tough when needed. There are lots of speculations. Not all countries have nominated their commission candidate yet. So we'll see.
Are there any names that you think would be... OK, you've done the job. You've talked about the skill set necessary. Are there any obvious candidates that you think stand out who could fill that role?
I don't see that immediately right now, but again, we don't have the full list of candidates. Big countries like Poland and Italy are still to nominate their candidates. So let's see.
Well, let's bring it back to and focus in on the European question, though. And you highlight the need in previous pieces that you've written as well, this need for free trade agreements that perhaps maybe take some of the pressure and some of the dependency off the likes of China and the United States as well. But it comes into direct conflict with some of the far right governments that we're seeing kind of add pressure in Europe, who are looking more inwards, who are looking for that protectionism. How does the EU fight that? In your former role, how do you push back against that from an economic perspective?
Well, you have to make the case all the time as a commissioner, but also member states. You need to explain to the citizens, you need to explain why this is important for our prosperity, for our growth, for our interaction with other countries. And with the uncertainty of the outcome of the American elections, we don't know who will be in the White House independently. Of course, US is a partner, but it can become even more tensions on trade. So we need to expand even broader. We have trade agreements with most countries of the world, but there are still others to be made and to be developed in Latin America, with India, and with the whole Asia Pacific. We have individual trade agreements, but we should be more involved there and try to find partners and allies, both in the car industry, but of course there's so much else, for instance, in the whole green technology.
Well, so I want to zero in on the U.S. conversation in particular, because, of course, we know right now, until the U.S. election is sorted and we get a new president in the Oval Office, there is a question of what happens to the steel tariffs that have been put on pause right now. And in the absence of that decision, the United States has chosen to do quotas instead on the EU. And I'm curious about that mechanism. Using quotas in place of subsidies or tariffs, is that a friendlier kind of tier 2 version of this global trade war? How do you deal with it? Are you more open to that? Your thoughts?
Well, those quotas need to go. I mean, the tariffs were illegitimate from the European point of view, and quotas is just something that we have agreed upon while trying to find an agreement in the working group that is dealing with the steel and aluminium tariffs. That was stalled. This is something that has to restart again as soon as the elections are over. There's a new president in place, and there's a new administration and a new commission in place in Brussels, which will happen probably in November.
And Cecilia, I have a slightly more sort of philosophical question for you about sort of globalization and trade. Did we over-globalize, right? Because for a very long time, it was very taboo to talk about this sort of thing. It was something that was relegated to the sort of populist fringes. But more and more, you see it in mainstream policy. You see it with Joe Biden. You see it in Europe, saying that we need to bring manufacturing back. And actually, we're willing to subsidize to that effect. My question, I guess, is how do you preserve the benefits of globalization without having as much of the punishing consequences as well? Can you actually do that?
I think you can, but you need to put it in a broader context of social policy, tax policy, different income policies as well, in order to make sure that people who are losing out of globalization get compensated and that they can have a chance to come in via training, education, and so on. So this is a very strong political leadership needed here, and we have seen that lacking in the US, in Europe, and elsewhere in the world as well.
Lacking leadership, but also lacking the funds, it seems, Cecilia, to add on to all these points, especially when he talks about that subsidization. We were just talking with the head of the French business lobby earlier in the program, who was saying we would love to be able to match the kind of subsidies and help that the U.S. government provides, and incentives provides, but there's no money in the budget to do it. Given that the EU is about to come on to some really tough budget talks, I'm curious if that's the next step that, from a trade perspective, you need to see from these European governments, finding the incentives and the subsidization within some of these domestic politics.
Well, that is a discussion that will continue during the fall. Some countries are very much in favor of raising the subsidies. Others are against, not only for economic reasons, but also for ideological. If we are creating a subsidy spiral in the world, it is not going to end well. It is going to lead to increased conflicts between countries and between the rich world and the poorer world. We have seen that before in history, and it's not going to end well. Some subsidies are needed, but what we need to do is to sit together in the world and find ways of defining what is a good subsidy, because sometimes there are good subsidies, obviously, and what is a bad subsidy, and how can I subsidize without hurting my neighbor? And that discussion must happen in international forums, in WTO, in G20, G7, or what have you. And but we need all the partners to sit around the table: Europe, US, and China. And with all the actions going on right now, I don't see it's happening this year, but hopefully. We need rules on this.
And you were EU trade. Yeah, and you were EU Trade Commissioner, quite notably when Trump came into power. How do you think that the Europeans should prepare themselves potentially for another Trump administration? How should they go about things differently in order to get a different outcome this time around?
Well, I think they're looking at different scenarios. Obviously, USA is an important partner and a friend, and we need to cooperate whoever sits in the White House. But we need to prepare, and that's why we also need allies. If there is a massive wave of new tariffs, 10, 20% all across the board, of course, Europe and other allies will have to retaliate. But it has to be done in a measured way, in a WTO-compliant way, and in a collective way. And then we need to find ways where we can cooperate on critical minerals, on some things on China, for instance, we can do, and on the green transition. And I think there are lots of there are different scenarios being drawn up now, but obviously it's the American people who decide who's going to sit in the White House.
Yep, and we've got a choice. We can either get Harris or we can get Trump. If we get Harris, Cecilia, do we get more subsidies, which are tough for Europe? If we get Trump, do we get more tariffs? Is that how we should think about this?
Maybe that's one, but it's more complex than that, obviously.
OK. But in broad terms, it kind of feels about right. Cecilia, great to catch up. Thanks for the time this morning. We'll look forward to having more conversations with you as we count down to the US election. Cecilia Malmström, the former EU Trade Commissioner and non-resident Senior Fellow at the Peterson Institute for International Economics. Thanks very much indeed. What are we going to talk about next? We're going to take you to what is happening in Ukraine and the Kursk region of Russia. The IAEA chief is leading a risk assessment trip to Kursk, the nuclear plant there, very much at risk, we understand. We've got fighting going on in the region. We've got an update on what is happening and that trip. That's next. This is Bloomberg. 47, nearly 48 minutes into the equity market session this Tuesday morning. This is what we are looking at, a fairly quiet session. Volumes have picked up a little bit. London is bouncing back, coming back, I should say. It was out yesterday, as a result of which you see that volume coming back in. You've got the BHP story to fold into the commodity story this morning, so you're seeing the basic resources tracking a little bit higher. That is where we're seeing the outperformance. Faded that a little bit. We're up by 1.1% on basic resources. The groceries are doing reasonably well. The food and beverage sector is doing very well as well, relative to the overall market. That tells you this is a cautious market. It also reflects maybe some of the tech sell-off we saw yesterday over in the United States. So that's the kind of the market picture this morning. It is quiet out there from a market point of view. We are mid-August. Think about this week as kind of the Christmas week, maybe, in terms of how the summer is progressing. We do have a video on Wednesday, of course. Let's turn back, therefore, to the geopolitics and talk about what is happening there. The head of the UN's nuclear watchdog says he is personally leading today's mission to the Kursk nuclear power plant in Russia, given the, quote, serious situation. He spoke to this program last week.
They do not have a protecting dome around them, which means that the core, the reactor's core, is pretty exposed. And when you add up this fact to the issue that you have advancing troops, objectively speaking, within artillery range, then this, of course, is a source of enormous concern to me and for the agency.
Director General Grossi warning of the risk and how exposed the Kursk plant is to the fighting that is going on around it. It doesn't have that protective concrete and steel dome. Let's talk about what we should expect from this trip. Bloomberg's Jonathan Tyrone joins us now to discuss this. The IAEA was warning, Jonathan, last week of a Chernobyl-style accident, the potential for it at this Kursk nuclear plant because of the lack of protection. What is the objective, therefore, of this visit that we are going to see today?
Well, Grossi just landed at the Kursk nuclear power plant about a half an hour ago. Basically, the IAEA is there to bear witness. There are liability issues if something does happen. Both sides have maintained over the course of this 2.5-year war that nobody wants to provoke a radiological incident. That would be very costly to Russia, which remains the world's biggest exporter of nuclear technology, nuclear fuel. Obviously, Ukraine has suffered under a radiological incident. It has more than 2,600 square kilometers of an exclusion zone around Chernobyl. The issue here is the reactors that are in Kursk and are operating are the same RBMK model that melted down in Chernobyl. These are reactors without a secondary core, these massive steel and concrete structures that are meant to contain radiation in the event of a meltdown. No other country in the world would operate this kind of a reactor. They are outdated and have severe engineering flaws.
So walk us through then, if these risks are so big, what is actually expected to come out of the meeting itself?
Well, the IAEA is limited. It's actually pushing the boundaries of its mission by even putting nuclear safety monitors in places like South Ukraine nuclear power plant, in Zaporizhia. Conceivably, Russia could ask the IAEA to set up a permanent mission in Kursk to monitor any events, stray rockets, stray UAVs, because if an accident does occur, and we're talking about a very narrow margin of error, the Russians in particular will want to have an independent monitor declaring who bears liability.
Jonathan Tyrone, he's our sort of in-house nuclear expert here at Bloomberg, joining us from Brussels. Thank you so much for your time today. Listen, we talk about the nuclear risk within the situation with Russia and Ukraine. There's also another risk that I think we saw yesterday, which was that Poland had said that one of the Russian drones had entered their airspace after that levy, that surge of attacks of cruise missiles and drones. Is that something that comes back into the conversation, particularly as, Ukraine turns up the pressure by its invasion and sort of entering into Russian territory? To what degree does that move the conversation forward? And as well, obviously, the energy conversation, where we see that, a huge amount of their infrastructure has been destroyed. And, of course, as we know, heading into the winter, very critical moment for Ukraine.
From a European point of view, the energy infrastructure is absolutely critical. From a Ukrainian point of view, it's obviously critical as well. But from a European point of view, some of the fighting is getting close to some of the gas transfer stations. It's getting close to some of the storage stations where gas is being stored. European traders, therefore, are backing away from that, which is raising the price. This is where potentially the risk lies for Europe this winter. we're coming out of summer, we're going into winter.
Yeah.
The moment things look all right, we're already seeing some volatility in the gas price, though.
And we got lucky, I think, last 2 winters here because, one, there was extra supply, and then the temperatures weren't as bad either. So it cushioned that. Do we see the same this winter? I think the point you make about the drones is really interesting on Poland, because when we had that conversation with the IAEA Director General, he was making the point that you can't actually, and of course he's doing this from as a third party to bear witness, as Jonathan said, but they're hesitating in terms of actually pointing the finger at who's behind this and using the fact that they are unmanned drones as mechanisms or as evidence of the fact that you can't actually track them down. I thought that was interesting, the fact that it is drone warfare that now seems to be driving that risk.
Yeah, it's a huge risk. This is the thing. The margin for error, as we were just hearing, that's where the challenge lies here, and making sure that when we're dealing with a nuclear power station here that has little protection, and you've got drones, you've got artillery. As we were just hearing, the margin for error is tiny here. This is a huge risk on Europe's doorstep. Yeah. We saw what happened with Chernobyl. Are people painting that kind of risk? Is this a risk more sort of commensurate with what we saw in Fukushima? Obviously, there we saw containment, but is that risk greater than that? These have been huge events that have shaped European energy policy in a big way. Fukushima basically took Germany out of nuclear power.
And willing to do so in the midst of their biggest energy crisis maybe in history. Yeah.
So these are critical events, not in terms of just what would happen in terms of the radiological release, but in terms of how energy policy will be shaped as a result of it as well.
Does this increase the appetite for nuclear energy or decrease?
I don't know. That's the problem. We don't know. It has had a material impact on policy in the past. Yeah. I'm assuming it would again. Anyway.
So there's a lot going on in geopolitics, of course. We're going to keep you apprised of the situation in Ukraine, arguably the Middle East as well. We haven't even talked about the Iranian component of the nuclear conversation as well. We should talk about, I think, going into tomorrow in the back half of the week, which, Guy, to your delight, will be perhaps a little bit more exciting, going into Nvidia tomorrow.
Going to get excited.
PCE on Friday. Guy's going to get really, really hyped. He's going to throw a Santa hat right out the window. I'm curious, though. I still feel like Apple is the story. That's the exciting one for me, at least today.
Why?
Going into Nvidia. Okay. So the CFO has taken a step back. We know that. But I actually think it's their. And I'm usually not someone to watch product launches this way, but. You've made this point very well, that Apple has been behind the game when it's come to AI, when it's come to et cetera. They're launching their iPhone September 9th. I thought it was
September 10th, and then I was going to ask you, what are you going to watch, the launch or the debate?
Luckily, the debate is September 10th and the launch is September 9th. So that's what I'll be watching. And just to hand that out as well, is that there's a private equity event in Paris as well as September 10th. Very exciting. We'll be there.
You got a lot going on in that period. Things are going to get more exciting. The back end of the week is going to be much more interesting. We are going to watch, obviously, and we're going to count you down to the Nvidia event. Ed Ludlow's got an interview. That's going to be amazing. I really can't wait to see what Jensen Huang has to say and the kind of tone of the conversation that we get with him. There are concerns around maybe some of the Blackwell chips being a little delayed, but as we were hearing from Mark Cudmore a little bit earlier on this programme, it doesn't feel like, even if you get a miss, it's going to be a material miss. It's going to be a miss that can be caught up later. But expectation.
Is this what we call a dovish cut or a dovish?
I think if you think about it as a central bank kind of event, maybe, but. I don't know. The market clearly has shown that it can deliver significant volatility. We saw that at the beginning of this month. Could Nvidia provide that catalyst again?
But the PCE on Friday, so then whatever shakes out on Wednesday, Thursday, does it just reverse on Friday? We tend to see that.
I'm waiting for September the 6th. The payroll number is the big number that we got to wait for.
That's true.
That's going to determine ultimately whether or not the Fed delivers 25 or 50. Anyway, that's it for the opening trade. That wraps it up for us. I'm going to continue. The Pulse is next. This is Bloomberg.